step is to make sure that the pattern you are following is indeed a legitimate formation. For example, the price action may exhibit all of the characteristics of a head and shoulders distribution pattern like this. It may also experience another right shoulder rally in reaction, but refuses to penetrate the neckline. We've already established that until the formation is completed with a decisive break below the neckline, it's not a true pattern. This is because the neckline represents a support area, and support has not been violated. In the case of a horizontal formation, failure to penetrate the neckline also means that the series of rising peaks and troughs is still intact. This is the kind of thing which happens as those who believed it was a top are forced to cover their short positions. Since fear is a stronger motivator than greed, these bears bid up the price very aggressively. In addition, those who are still believers but are not yet long rush to correct the situation. There are several points on the chart where the probabilities of a valid signal sink below 50%, and those of an outright failure start to increase. Let's take a closer look at one of these situations. This diagram starts off with a perfectly good downside break from a head and shoulders top. The next rally is a perfectly typical development because retracements are normal. But then something unexpected happens. Instead of following through on the downside, as would be expected from a head and shoulders top, the price rises back to the neckline again. This is the first sign that things may not work out as expected. When the price once again rallies back above the neckline, the odds of a failure increase. After all, the break above the neckline signals that the rising peaks and troughs are the order of the day. The balance tips more to the bullish side when the price moves above the downtrend line, joining the head with the right shoulder. This is probably the time to cover any shorts. Since the reason for going short in the first place, that is the breakdown, no longer exists. Now this is important, for the nature of the trend line will have a great deal to do with the change in the probabilities. For example, if the line is steep and has only been touched twice, it will have nowhere near as much significance when penetrated as if it was a shallow line and had been touched several times. A refresher on trendline interpretation from a basic building block module might be a good idea at this point. The next line of defense is the right shoulder. If the price can rally above this point, then in some cases it would now be experiencing a series of rising peaks and troughs if it was not doing so earlier. Finally, when it moves above the head, the pattern is cancelled beyond a reasonable doubt. If action on the long side is contemplated, it should be taken either when the price breaks above the trend line, joining the head with the right shoulder, or when it breaks above the right shoulder on heavy volume. Usually such signals offer substantial profits in a very short period of time and are well worth acting on. Again, some common sense comes into play, for if the trend line joining the head and the right shoulder is unusually steep and has been touched only twice, it would not have the authority of a more shallow one that's been touched or approached on more numerous occasions. The main thing to bear in mind is not how much money you're going to make, but what's your loss if things go wrong? For example, if it makes sense to put your stop below a good support level, such as the neckline, the line joining the head with the right shoulder and so forth, and this risk is minimal, it's a good idea to put on the trade. If not, there's always another train leaving. Failed tops are probably due to misplaced pessimism. Once the real fundamentals are perceived, not only do new buyers rush in, but also traders holding short positions in anticipation of the decline are forced to cover. Failures used to be quite rare, but now appear to be much more common. This underscores the need to wait for a decisive breakout on the downside, or on the upside in the case of a reverse head and shoulders. Failures typically develop when the indication from the pattern suggests a break in the opposite direction to the then prevailing trend. For example, an upside break in a primary bear market. Generally speaking, if you can observe a failed pattern, the very failure may be interpreted as a sign that the prevailing dominant trend is probably still in force. Inverse head and shoulders patterns can also fail, as we see from this diagram. We start off with a perfectly good breakout. As I uncover some more of the action, you can see that there's an excellent little trend line joining the head with the right shoulder. Now if that gets violated, the odds of a failure will be pretty high. This is because the line is shallow and it's been touched on several occasions. The potential joint break with the neckline is also impressive and would also greatly increase the odds of a failed pattern. As we proceed, you can see that it was violated, as was this horizontal line. My view is once the head with the right shoulder trend line has been penetrated, that's certainly enough to liquidate any longs. After all, the reason you got in, that is the breakout, is no longer in force. The price may break to the upside again, but at this point the odds do not favor such a scenario. Better to limit losses to fight another day than to go against the probabilities. Upside whipsaws are usually followed by a fairly lengthy decline, as participants who bought in anticipation of an upward breakout are flushed out when the new bearish fundamentals become more widely known. Here's an hourly chart of December silver. At this juncture, the price action is pretty impressive, as we see a nice breakout from a reverse head and shoulders. After 2 more hours of trading, the breakout is no longer in force. Before we got into the trade, we should have asked ourselves where to place the protective stop in case things went against us. In this case, it's pretty obvious, just below this trend line. What a great support area it is, since it's been touched or approached on numerous occasions. Consequently, when it was violated, it gave a great signal that the upside breakout was a whipsaw. Here's a chart for the Philadelphia Gold and Silver Share Index. It looks as if it's in the process of forming a head and shoulders top, and indeed it breaks below the neckline. As we move on, the price rallies a bit and violates this trend line, joining the head with the right shoulder. This is a strong sign that the pattern will fail. Later on we can construct this small inverse head and shoulders. I grant you this is a bit of a stretch, but so was the subsequent rally. Once again, the important point is to demonstrate the power of the whipsaw. Occasionally a head and shoulders pattern, whether inverse or regular, will be counseled by another formation. The idea is that markets reflect people in action, and people can and do change their minds. So therefore, do markets. Let's look at this example. Here's a head and shoulders top with a successful breakdown. More price action reveals a resistance level at the extended neckline. Already there's a possibility of an upside reversal with a break above this trend line. Finally, as we see more price action, it's evident that the head and shoulders top was immediately followed by the formation of an inverse pattern. When the price breaks above the 2 necklines, that's the odds-on signal that it's the bulls who are now in control. Note that the top formation had already reached its minimum downside objective, so it had already done its job. A good example of this concept is presented by Apache Corp, which broke down from a head and shoulders. In this case, the downside objective was not quite met, but note that the price immediately began the formation of a reverse head and shoulders. In this case, the accumulation pattern cancelled out the distribution pattern, and its objective was not immediately achieved, but required several rallies to do so, including, would you believe, a consolidation reverse head and shoulders. Finally, this 15-minute close-only chart for Microsoft contains several head and shoulders events. First a top just here, then a decline, and a well-formed inverse pattern. Then a top that didn't work, and how about that for a rally? And the next event is another top, and finally a reverse head and shoulders. In summary, there are several clues we can look for that suggest that a pattern will fail. 1. Heavy volume on the right shoulder of a potential head and shoulders top. Light volume on a reverse head and shoulders breakout. 2. Failure of the price to follow through in the direction of the breakout following a retracement move. 3. The overall market and other stocks in the industry group failing to act in sympathy. 4. Momentum indicators at the time of the breakout are extremely oversold in the case of a top, or overbought in the case of a bottom. Momentum is covered in a subsequent module. Head and Shoulders tops review. 1. Price characteristics. A final rally separated by two smaller rallies at tops. 2. Volume considerations. Very heavy on the left shoulder and sometimes on the head. Low and shrinking volume on the right shoulder rally. Immaterial on the breakdown, but heavy volume is preferred. 3. Measuring implications. Distance from the top of the head to the neckline projected down at the point of breakout. 4. Signs of false breakouts. Presence of a second retracement rally and failure to break the initial breakdown low. A rally above the trend line joining the head with the right shoulder, provided it's not unduly steep. Head and Shoulder bottoms review. 1. Price characteristics. A final low separated by two higher lows at bottoms. 2. Volume considerations. Heavy volume on the left shoulder and sometimes the head. Low and shrinking volume on the right shoulder decline. Very high volume accompanying an upside breakout. 3. Measuring implications. The distance from the bottom of the head to the neckline projected up at the point of breakout. 4. Signs of a false breakout. Contracting volume on the breakout. Price cannot hold above the breakout for more than 2 sessions. 5. Places to unwind positions in case of a whipsaw breakout. The violation of an uptrend line joining the head with the right shoulder. A break below the right shoulder, especially if accompanied with expanding volume.